Hey everyone, welcome back to Corporate Decoder. Today, QNCX just filed an amendment on a reverse stock split, and I think this is a move that could signal trouble ahead. Quick note, this is not financial advice, just my take on public filings for educational purposes. Quince Therapeutics is doing a 1-for-20 reverse stock split. And historically, this often means a company is struggling to keep its stock price up. So Quince Therapeutics, Incorporated, a company in the healthcare industry focused on biotechnology, has filed an amendment to a previous report. Think of this amendment as a correction or an update. The main point here is to fix a mistake the company made in their earlier filing about a reverse stock split. Essentially, this filing is a do-over for a specific part of their last report. What they are correcting is the description of a reverse stock split. This means the original explanation had an error and they needed to send this new document to set the record straight. Now, let's get into what this reverse stock split actually means for the shareholders. A reverse stock split is when a company reduces the number of its outstanding shares. They do this by combining a certain number of existing shares into one new share. Back in June, the shareholders gave the green light for a reverse stock split. The range they approved was quite broad, from as low as 1 share for every 10 old shares to a much more drastic one for 100. This meant the company had the flexibility to decide the exact ratio and when to implement it. So after getting that approval, the board decided on a 1-for-20 split. This means for every 20 shares you owned before, you now own just 1 share. This filing confirms they have officially submitted the paperwork to make this change happen, and it will officially go into effect very late on the 29th of June. This means that as soon as trading opens on the 30th of June, the stock price will be adjusted to reflect this split. If a stock was trading at, say, $2 a share before the split, after a 1-for-20 reverse split, it would theoretically trade at $40 a share. The total value of your investment stays the same, but you own fewer shares. This just reaffirms the 1-for-20 ratio. The value of each share goes up proportionally to the decrease in the number of shares. Here is an important detail. If a shareholder owns a number of shares that does not divide evenly by 20, they won't receive a fraction of a share. Instead, the company will round up to the nearest whole share. This could mean some shareholders end up with slightly more shares than a strict mathematical split would suggest, or in this case, they are rounding up. This is where we see the impact. Before the split, Quince Therapeutics had over 19.5 million shares floating around. After the reverse split, they will have just under 1 million shares. This is a massive reduction designed to boost the per-share price. Your stock symbol, QNCX, remains the same, but there is a new identification number for the shares called a QSIP number. This is common practice after a stock split or significant corporate action. This also means that if you hold stock options or warrants in Quince Therapeutics, those have also been adjusted to match the new share structure. The number of options or warrants will decrease, but the strike price will increase proportionally. The company has designated a third-party agent to handle the technical aspects of this share consolidation. For most investors, especially those holding shares through a brokerage account, this process should be automatic. Why do companies do reverse splits? Usually it is to avoid getting delisted from major stock exchanges like the Nasdaq. Exchanges have minimum price requirements, and if a stock trades below a certain level for too long, it risks being booted off. A reverse split artificially inflates the stock price to meet these requirements. Historically, a reverse split is often a symptom of underlying business trouble. In the last few years, we've seen many smaller companies with struggling stock prices resort to reverse splits. For example, when Kodak did a 1-for-20 split back in 2021, its stock eventually continued on a downward trend, and that kind of move often leads to further struggles. Roughly half of micro-cap companies that do reverse splits end up delisted within a few years. For Quince Therapeutics, the stock price has been very volatile. At its peak, it was trading in the mid-40s, but it is now around 94 cents. This indicates significant challenges or a lack of investor confidence. Their market cap is currently only $18 million and they have just 38 employees. This suggests it is a very small player in the biotech space. Recent news shows they presented some positive phase 2 data for a therapy called LAM-001 in early June, which is good. However, the stock price action leading up to this reverse split suggests that positive news hasn't been enough to overcome broader market sentiment or underlying company concerns. Cantor Fitzgerald did reiterate an overweight rating on the 25th of June, which is a positive signal from at least one analyst. But the reverse split itself speaks volumes about the company's efforts to maintain its listing. The risk here is that this reverse split might only be a temporary fix. If the company doesn't improve its fundamental business performance, the stock price could continue to fall after the split, potentially leading to delisting anyway. It is like putting a bandage on a wound that needs surgery. What I am actually looking for is whether Quince Therapeutics can translate that positive phase 2 data into tangible growth and revenue. My biggest concern is that this reverse split is a sign of distress, and unless there are significant operational improvements, the stock may continue its downward trajectory. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like, subscribe, and join our Discord in the description below.